the next presentation, to the next panel discussion, which is on the topic, Empowering Businesses with Seamless Supply Chain Finance. Our moderator for the same is right up on the stage, Mr. Manoj Agrawal, Group Editor, Banking Frontiers. We have Mr. Ganesh Ramani, Chief Business Officer and Chia, and I request Mr. Rahul Ghule, Head of SCF, Profectus Capital, to please come up on the stage and join them. Let's have a round of applause once again, ladies and gentlemen, for our next panel discussions.
Okay, so what we'll do, we'll dive deeper into the subject, look at it from some more angles, with Rahul joining us from Profectus Capital, a leading NBFC, leading specialist NBFC, B2B kind of NBFC, to manufacturing sector, to education sector, and others. So Rahul, if I come to you, give me a little bit of history of supply chain finance business at Profectus Capital. Just a brief intro.
Sure, Manoj. Thank you so much. So at Profectus Capital, when we talk about supply chain financing, we have adopted essentially a anchor-led or a corporate-led model, wherein we tie up with larger corporates like, for example, we have a tie-up with Tata Solar or Redington or Ingram Micro, and then through this tie-up, we are funding their distributors for purchases of stocks from all these anchors. So we are essentially playing a very vital role of moving stocks down the entire supply chain, from the anchor to the distributors, right? So that is what we are doing. We have roughly about 400, 500, 450 odd crores of portfolio in supply chain financing, which is spread over at least about 22 anchor corporates with whom we have a tie-up. And that's how the entire... so we are basically funding MSMEs who are purchasing stocks from the larger corporates. That's what we are into.
From the anchor. And when did Profectus get into this line of business?
Yeah, we started supply chain financing way back in 2019. And so that's where we are. So I'm just circling back to one of the points that we discussed, that you discussed earlier, that supply chains across various sectors have been through a lot of stress during the pandemic. And at that point of time, all the customers whom we had funded, we were able to support those distributors to ensure a smooth flow of goods into the marketplace and a assured line of credit, which really helped them in a very big way to manage the supply chain disruption, right?
Okay. So apart from disruption, when there is normal flow of business, what does this business model need? More of data, more of technology, I don't know, more of something else? What is the key drivers?
Sure. Thanks, Manoj. So what I feel is that supply chain finance, as compared to any other line of business, as far as financing is concerned, is a very operationally heavy business, right? Because in typically a mortgage loan, you disburse and then you just have to keep on getting the repayments, right? Whereas in supply chain financing, what happens is the underlying product is a rotating limit, which means there are a lot of transactions, right? So, which is where technology plays a very, very important role, right?
I see.
So we have to make the operation easy for the customer, fast process. We have to build a very fast-paced solution, and it also has to be flexible, right? So those are the main challenges, because operationally it's really very heavy.
Okay, so speed is very critical.
Speed is very critical.
Very critical, okay. Ganesh, what has been your experience with engaging with the NBFC partners that you have? How much do you see them valuing speed, flexibility, operational support? What have been their ask from an IT company like yours?
Yeah, thanks for the question. So in fact, we support both banks and NBFCs as our clients. So in fact, I think he's put the point very well. Firstly, supply chain finance is all about B2B, right? So, all along today, since morning, we've been
B2C,
hearing about
yes.
B2C.
Yes.
So this is one of those conversations that's focused more on B2B lines of business. So from our standpoint, what we've been doing is we understand the line of business of our customer, right?
Okay.
While we have a platform that supports probably every line of business or every line of activity within the supply chain finance ecosystem, right? Or whether it is an invoice discounting or a payables, financing or a blockchain-based financing. I mean, blockchain is evolving, right? So, but we, as a platform, or factoring or whatever is a business. So the platform is available to support any of these lines of activities that, or even a trade finance or a dealer finance, which some of the supply chain finance businesses do. I mean, sometimes they treat it separate from supply chain finance, but some of the institutions do it, but some of them do it under the aegis of supply chain finance. So from a product standpoint, it's all enabled. Now, what happens is every activity is different. Some of them, he mentioned about the anchor-driven business. The anchor-driven business is a three-party transaction, whereas the dealer finance is a two-party transaction. So from a technology standpoint, we need to understand the business that our customer is in, and then have the platform ready with all the upstream and downstream integrations and interfaces, which is a necessity today for a seamless, frictionless operation. And you mentioned this is a operations heavy or a transaction heavy. So unless we are able to support that through our technology enablement and have the upstream and downstream integrated, down to even integrating with, say, the ERP systems of a supplier or the OEM, right? Now that's where the trick lies, and which is where we have been fairly successful in enabling this for our clients. For example, we work with some of the large, OEM financiers who have supply chain finance as one of their business. They are into multiple lines, but the supply chain finance is one of their businesses. And we have had to integrate not just with the usual fintech aggregators, but with the ERP systems of both the OEMs and the suppliers. So it's a extremely critical value chain that we need to set ready or get ready with, which enables this frictionless, operational heavy framework. So which we have been, so that's I think a very intricate requirement of some of the lenders in this line of business, which we have been able to do.
So from what both of you said, two questions come to mind. One is you spoke about all this range of integration. So is that like a technology intensive work, or does that require some amount of intelligence and planning so that it happens smoothly? How does it work out for both for a lender and for a technology company?
So I'd like to answer this question a little differently, Manoj, with your permission. So I completely buy Ganesh's point that a good supply chain financing IT solution has to have the capability or the flexibility of integrating with multiple stakeholders, right?
Okay.
Now, where this becomes really very essential is that in supply chain financing, it's also very essential that one NBFC financier continuously monitors the customer, right? And from monitoring perspective, monitoring is obviously again a very data heavy kind of exercise, right? Because otherwise, historically or traditionally, what has been done in supply chain financing is you assess, the lender assesses a distributor now, and then there is a renewal which happens 1 year down the line. So between two terminal evaluations, the visibility of how the enterprise is doing, whether they are doing good in their business or is there any degradation in business, this is something which largely all financiers in supply chain finance domain have been blind to, right? So the continuous monitoring is something which is really missing. Now, what we have also seen happen parallelly is the account aggregation as a thing is really coming up very fast, right? So, account aggregation is something which can solve the monitoring aspect of supply chain financing by being able by enabling the financiers to pull out the bank statements, by enabling financiers to pull out the GST returns on a regular basis and do mini reviews either on a monthly basis or set up early warning systems which are derived out of all these data points, right? So, this may sound a little fantastic, but if there is a IT solution which integrates with, as Ganesh said, with the OEMs or the anchors and their distributors or their suppliers, the IT solution which also brings in account aggregation integration along with it, right? But I think I'm very optimistic about IT companies like Uncia because whatever looks as a fantastic solution now, our IT companies have delivered they've made it a reality in the next 2 to 3 years, right?
Okay.
So I think that is where the real challenge of supply chain finance lies. But over to you, Ganesh. I mean, if you could throw some light and maybe correct me if I'm wrong, whether such solutions are possible.
Good insights.
Yes, thrown a challenge at us. So, so your point is right, Rahul. So we are at that throes of a complete ecosystem change where account aggregation has become a reality. Now, how much of it? So again, account aggregation has largely been again in the B2C space. We haven't seen. While, of course, we have been speaking to a few account aggregators, and they all have intentions of doing a lot of things in the B2B as well. But 80% of their focus has been on B2C. While, of course, this will change, and they will add up B2B as well. But what we have seen, and to complement what Rahul mentioned, for us, API interfaces is the key, right? And whatever he mentioned and what I mentioned a little while earlier, API interfaces is the only way seamless, frictionless, operational heavy transactions can be operationalized, tracked, monitored, and managed. And that's the key to any large supply chain finance business being sustainable, because again, we all know, and Rahul, I'm sure you'll agree, it's a low margin business. You cannot afford much of leeway in your operations. It has to be managed through a very slim operative framework at a lender level. So therefore, it requires that technology framework, the entire technology ecosystem to support and enable this business for them to scale up, be profitable, and improvise on their margins. So open APIs and API interfaces with the ecosystem is the order of the day, and that's what we bring to the table.
So that kind of answers the next question I was thinking about. So one is operational efficiency, other is operational flexibility. You're saying API gives that kind of flexibility to the supply chain financiers to connect here and there, partners,
agility
ecosystem
as well.
partners, and get the data. And using that data, then provide the credit, manage the risk, do the underwriting, stuff like that. That's interesting. So does that mean that Uncia has to be like is API creation, integration like the DNA of a supply chain solution like yours?
No, that's not our DNA. It's an enabler to the business. So our core is the product, right? If the product is not there, then none of it helps. So our product is the core.
Okay.
The enablers are, obviously one of the enablers is the API interfaces to the ecosystem, both upstream and downstream. Two is, the compliance and regulatory, requirements from a regulatory perspective. So adherence to that, compliance to that, because be it typical term loans or SME loans, even supply chain finance regulatory requirements are there from a B2B standpoint. So that is very, very critical. Three is data integrity and data security, because we are here, since we are connecting both upstream and downstream to OEMs and stuff. That integrity, data security, and a segregated environment to run these programs on a large scale basis is extremely critical.
So Rahul, like he said, core is the product. So how easy or difficult is it for a supply chain financer to look at SCF technology companies and identify whether they have the right kind of products to match your needs or not? Is that a very complex exercise or can be done with reasonable effort?
See, I think my view, Manoj, would be that different financiers in the supply chain finance domain have different appetites, right? So different financiers have different business models, let me put it that way, right? So I think what I would look for in a supply chain financing solution is the flexibility of being able to house all the business models that exist in the industry, right?
Okay.
So that is something which is very important. So obviously, I anticipate that the core solution that Ganesh was talking about would have to be a broad-based to accommodate all the business models, right? I'm not getting into the business models right now because obviously it will be too long conversation. So being able to house various business models will be critical. I think what will also be a core capability is the API capability that Ganesh talked about. That being able to, while it may the API integration may not be a core, but being able to offer that would be a very valuable service from a financier's perspective.
Does it have to come from the same partner, or can there be an API specific partner?
See, I think both from the partner's perspective, it would be a good value to bring to the table, number one.
Okay.
And obviously, better value is better commercials and stuff like that. Because but obviously that's a choice that companies like Uncia have to make, because it has to resonate with their own business model and stuff like that. But I would always prefer, instead of too many handoffs, if there is an integrated solution which comes from a financial perspective, I think that would be more desirable.
Yes, that would reduce the complexity and...
We wouldn't give up the APIs.
Pardon?
We wouldn't give up the APIs. It's our...
Correct. Okay. Since you mentioned that you have banks and NBFCs as clients, at a broad macro level, are the requirements mostly similar, or there are quite a few differences?
So I'd categorize it into two aspects. One, financiers who have OEMs as their parent, right, and then the others, right. Say, for example, a Profectus Capital is a classic example, who don't have, the upstream or downstream in their ecosystem. So for them, it's all natural market, new to base, new to Profectus customer kind of business. Whereas we have clients who have OEMs, and we have at least 4 of them, where the OEM is the parent, and they are the financials themselves, and they have the entire value chain, right? So, they have a very, and we work with one of the automobile financing companies that have an extremely complex I would say network or ecosystem of their supply chain, which we have catered to. In fact, they are our customers, long-standing customers. We've just upgraded them to our new platform on the supply chain, and they're doing fabulous business. So, we segregated between the OEM-based financing and the non-OEM-based financing. The product is enabled for both, but the nuances of both the businesses are a little different, because an OEM-based financer necessarily does not do say a requirement underwrite or an underwriting requirement for an OEM, right? But if you look at a Profectus, they would do both upstream and downstream credit underwriting before they onboard them. So that is something which is a nuanced requirement of specific financials. There are others as well. But,
Okay, so this
but
is-
the product is typical. The system is catered to both types of financials, depending on the nuances.
Okay. As an NBFC, do you see any other major differentiation between a bank and an NBFC doing supply chain finance?
Barring rates.
Yeah, rates is a very big issue. But what I also feel is that appetite would be a very clear issue. Because banks typically, if I look at a supply chain, the banks would always prefer to fund, if we were to arrange the supply chain partners in the order of their credit worthiness, I think the banks would satisfy largely the top 15 or 20% of the distributors or suppliers or whatever.
Oh.
That leaves a very big mass of distributors or supply chain finance partners whom banks or even the larger NBFCs may not be willing to fund, right? So
Okay.
which is the gap which NBFCs like Profectus Capital, we are filling that gap essentially, number one. Which makes the monitoring bit really very important for us, because obviously as you come down to the little less credit-worthy kind of supply chain partners, the monitoring has to be spot on, number one.
Okay.
Number two, the way we differentiate ourselves from the larger NBFCs or banks is on the speed of response. Right? Almost about 93% of our transactions here at Profectus Capital are disbursed, done and dusted within 60 minutes. Right?
Wow.
So, which is essentially on account of the supply chain finance portal, which we have opened up to the customers, where they can raise invoices. The portal portal itself is integrated with our LMS, and LMS is in turn integrated with the bank side, right? So, which is what is giving us a lot of optimization over there. At the same time, every tranche related, there is a bit of underwriting which we have digitalized, right?
Okay.
So for almost about 80% of the transactions, we are able to offer a straight-through process, right? So which is what, while banks would possibly have this, but even the larger NBFCs don't have a straight-through process, which is my, as I'm aware of that, because that is what the anchor corporates keep on telling us. And they've really appreciated the kind of, speed of operation that we have brought to the table. So I think these are, appetite, and the ease of operation and the speed of operation is how we are different as compared to banks and larger NBFCs.
Very interesting. Thank you both for sharing both those perspectives. We're kind of coming time-wise to an end. If we can take questions, one or two questions from the audience. Anyone has any question for either of our panelists? Yes, please. Can we have the mic here in the center?
I'm Manikandan. I'm from Credible. I had the credit and risk. So about ERP level integration with anchors, right? So technically, yes, it is feasible, but economically, if you see most of the cases, it will not be feasible. But from the risk point of view, I would always prefer an ERP level integration, because EWS runs better with more data points, more granular data points, and live real-time data, right? So it becomes a kind of chicken and egg story, right? So you first do the integration and then we relax the rule engine, or first you relax the rule engine and then we see some velocity, and then we integrate at ERP level. So how do you manage this kind of impasse that happens?
As an entity who is taking the risk, I would always prefer that the API integration is put in place first, because that obviously gives us a lot of assured visibility of a lot of monitoring data. Practically speaking, if we talk about a large corporate who is essentially working with 4 or 5 financiers, API integration with their ERP, if the corporate starts integrating with each financier, that's going to be a challenge for them. And while the industry may have seen some integrations, but the integration with the ERP has really not taken off at a huge scale. That's the challenge which I very clearly foresee. But yeah, I mean, to answer your question, I would always prefer that API integration is put in place first, so that gives us a very good visibility on a regular basis.
Yeah, to just add one point to what Rahul said, it's not easy. The integration is, we know the man effort that got spent to get this enabled, because the corporate themselves have their own, ways and means of, or nuances of either doing it or not doing it. They wanted to do it, but obviously they have their, boundary walls beyond which they will not allow us to integrate. So we had to sort of deep dive into that before we enable that process. But you're right, once the integration is done, there's a fairly good leeway for lenders to relax on the credit underwriting rules. You got much more access to data, and that will help in the entire value creation process.
Also on the account aggregator side, how effective it is in strengthening the EWS or the behavioral model of your company?
I think it gives a very good visibility of what is the velocity of the business between the supply chain partner, who is the borrower, and the anchor corporate, right? So it completes the EWS. It completes a very important portion of the EWS. Obviously, EWS has to be much more elaborate, which touches upon a lot of other data points which are either available in the public domain, or you still have to get a bank statement from the customer on a regular basis, so on and so forth. But yes, it completes the EWS because it gives us a very clear picture of how are the transactions, what is the velocity of transaction. Is the distributor buying as much as he was buying when we decided to fund the particular distributor? That's the point that I'm trying to make.
Well, thank you so much.